Welcome back to the Daily Briefing here on the Deep Dive. It is Thursday, February 19th, 2026. And I have to say, if you have glanced at your portfolio today, or really even just the news notifications on your phone, you are probably feeling a very specific mix of confusion and mild nausea right now.
Oh, mild nausea is probably doing a lot of heavy lifting there.
Yeah.
It has been an absolutely brutal 24 hours.
Yeah.
Chaotic is really the more accurate term for what the markets are digesting today.
It really has. We are looking at a day that feels, it feels almost like a head-on collision between two completely different eras of history.
Right.
On one side, you have the old world, you have oil prices spiking, war scares in the Middle East, supply chains choking up. That's dragging the equities down to their worst levels since the union budget.
It feels very 20th century.
Exactly. Very 20th century. But
Basically, in the same breath, you have the future crashing in. You have Reliance Industries placing the single largest corporate bet in Indian history. And it's not on oil, it's not on retail, it is on artificial intelligence. Plus, you have the Prime Minister hosting the world's tech elite in New Delhi right now.
it's a complete split-screen moment. You've got sheer fear on the left and massive, massive ambition on the right.
And that is exactly our mission for today's briefing. We have a huge stack of reports here, specifically drawing from Business Standard and the Economic Times, along with the live market wire feeds.
Right.
Our goal is to cut through all of that noise. We need to figure out why the market is panicking today, but more importantly, why the biggest players in the room are seemingly ignoring that panic entirely to build infrastructure for the next decade.
We are stripping out the ads, we are stripping out the noise to give you the signal. So we'll start with the big five headlines just to get you oriented on the raw facts of the day.
Then we're going to do a proper granular deep dive into this market crash.
Specifically, this AI scare that is just hammering the IT sector.
Right. Is it real? Or is it a narrative that's just spinning totally out of control?
Then finally, we will unpack this trillion rupee AI wager from Ambani and Tata.
And as always, stick around for the end. We have compiled an investor's cheat sheet.
10 specific developments from today's chaos that actually changed the long-term investment thesis for you.
So let's get to work.
All right, let's run the big five. These are the stories moving the needle right now. Headline number 1, the market bloodbath.
It was a sea of red today. There's just no sugarcoating it. The Sensex crashed over 1,200 points.
Wow.
That is a 1.5% haircut in a single session, closing down at 82,498. The Nifty gave up 365 points to end at 25,454.
And just to contextualize that for you listening, we haven't seen a single day drop this sharp since the union budget earlier this month. This effectively wipes out weeks of gains.
It's a very significant correction, and the drivers here constitute what analysts are calling a perfect storm. You have a massive spike in geopolitical fear regarding Iran, which we will get to, colliding with a very aggressive sell-off in technology stocks.
It is super rare to see energy fears and tech fears peaking on the exact same day. Which brings us to headline number 2, the counter-narrative. While the market was frantically selling, Mukesh Ambani was buying, or rather, pledging.
A massive pledge. Reliance Industries announced an investment plan of 10 trillion rupees.
10 trillion.
That is roughly $110 billion over the next 7 years.
I just want to sit with that number for a second. 110 billion. That is larger than the GDP of several mid-sized nations.
It is a staggering sum. And the target is what they are calling sovereign compute infrastructure. Ambani is effectively trying to do for artificial intelligence what Geo did for mobile data.
Make it abundant, affordable, and domestic.
Exactly. He explicitly called this patient nation-building capital. That is his way of telling the market, hey, I don't care about your quarterly panic. I am building for 2030 and beyond.
Right. Headline number 3, the geopolitical flashpoint. This is the source of the immediate anxiety for the day traders.
Tensions are just boiling over in the Middle East. The specific trigger for the market today was a report out of Iran's state media regarding a potential brief closure of the Strait of Hormuz.
The world's oil valve.
Roughly 20% of the world's oil consumption passes through that narrow strait. That rumor alone, even unverified, sent Brent crude spiking. It briefly crossed $71 a barrel today.
And markets absolutely hate uncertainty. The threat of U.S. intervention in Iran is about as uncertain as it gets for global supply chains.
Headline number 4, the Global AI Impact Summit.
While the markets were tanking, New Delhi was hosting the tech elite. Prime Minister Modi unveiled the MANAV vision for AI.
You had French President Macron there, Brazilian President Lula, And CEOs from OpenAI to Microsoft all in attendance.
It's a major push for the Global South to essentially be the architects of AI, not just the consumers of it. And finally, headline number 5, a shakeup in the boring but incredibly important world of GDP calculations.
The National Statistical Office is moving the GDP base year to 2022-23. But the fun detail here, and the one that actually impacts how we measure your grocery bill, is the consumption basket.
Right, the butter and ghee thing.
Yes. They're moving butter and ghee out of milk products and into a newly recapped oils and fats category.
Which sounds totally trivial, but it fundamentally changes how we track inflation.
Drastically. It's a granular update, but it's going to change the inflation data inputs for the Reserve Bank of India.
Okay, so those are the big 5 headlines. Let's slow it down now and figure out what is actually happening beneath the surface here.
Let's start with the market crash.
Yeah, I want to unpack the red ink. Sensex down 1,200, Nifty down 365. When we see a drop like this, the first question is always, is this a knee-jerk panic or is something structurally broken in the economy?
It looks like panic, but it is panic with a very rational basis.
Yeah.
If you look at the fear gauge, the India VIX, it jumped 13.5% today.
Now, for those who don't watch the VIX daily, explain what a 13% jump actually signals on the trading floor. That seems huge.
Oh, it is huge. The VIX measures volatility expectation. Essentially, it tracks the price of options premiums. When it spikes like that, it means traders are frantically buying insurance on their portfolios.
They're paying a premium to protect against further downside.
Exactly. It tells you that the market isn't just taking profits. It is scared of what tomorrow morning looks like.
And the source of that fear seems to be dual-pronged based on the business standard reporting. Let's tackle the oil issue first. The Strait of Hormuz. We hear this name every time there is tension in the Gulf. Why does a rumor about a waterway thousands of miles away tank the Sensex in Mumbai?
It comes down to basic energy security and very simple math. India imports the vast majority of its crude oil, over 85%.
Right.
And the Strait of Hormuz is a geographic choke point. If that strait closes, even for just a few days, the supply chain snaps. Ships cannot get out of the Persian Gulf.
And the price reaction is instant.
Instantaneous. We saw Brent touch $71 today. Now, 71 isn't historically astronomical. We've seen oil over $100 before. But it's the trajectory and the speed of the move that terrifies investors.
Because if oil spikes, a domino effect starts.
3 things happen immediately. 1, India's trade deficit widens because we are paying more dollars for the same amount of imported energy.
2, the rupee weakens against the dollar as a result.
And 3, most importantly for domestic markets, inflation goes up. Fuel costs impact logistics, which impacts the price of everything from vegetables to cement.
And if inflation goes up, the Reserve Bank of India essentially gets handcuffed.
That is the crux of the market fear. The market has been pricing in interest rate cuts later this year to help boost economic recovery. If an oil shock spikes inflation, those rate cuts are completely off the table.
The RBI can't cut rates when oil is burning.
Exactly. That means the cost of capital stays high, loan EMIs stay high, and corporate earnings recovery stalls. That is why Dalal Street reacts so violently to a headline out of Tehran.
The irony here, looking at the Economic Times coverage, is that there was supposedly a U.S.-Iran trade deal agreed upon.
That's the frustrating part for anyone trying to trade this news. Diplomats were making progress, but the fear of military intervention, perhaps triggered by misunderstanding or non-state actors, is completely overriding that diplomatic optimism.
The market is pricing in the absolute worst-case scenario because the cost of being wrong is just too high.
Precisely. But that is only half the story of today's crash.
Right. You mentioned a second factor, a very specific targeted sell-off in IT stocks. This wasn't just broad market panic dragging everything down equally.
No, this is fascinating, and honestly, it is the more significant story for long-term investors. Foreign portfolio investors, the FPIs, have been dumping Indian IT stocks at an alarming rate.
How much are we talking about?
They sold nearly 11,000 crore rupees worth of IT stocks in just the first half of February alone.
11,000 crore. That is a massive exodus.
It is the worst fortnightly exit from the IT sector since July 2025. And the narrative driving this capital flight is what the papers are calling the AI scare.
We have heard this buzzword thrown around a lot, but let's break it down mechanically. Why does the rise of AI agents make an institutional investor in New York dump their shares in Infosys or TCS?
To understand the fear, you have to look at the traditional business model of Indian IT services. For decades, it is built on labor arbitrage.
Meaning you hire smart engineers in Bangalore or Pune to write code, test software, and maintain legacy systems because it is significantly cheaper than hiring developers in Silicon Valley or London.
Exactly. It's a business model fundamentally based on headcount. You win a bigger contract, you hire thousands of more engineers, it's linear growth.
It's the engine that built the Indian middle class.
Well, the fear that has gripped foreign investors is that agentic AI tools like Claude, OpenAI's advanced models, Google's new agents, can now do a large chunk of that work. Not just assist a human, but actually execute the tasks autonomously.
So the logic goes, why pay an IT firm thousands of dollars a month for a team of junior developers to write boilerplate code when a client can pay an AI provider a fraction of that cost to generate it instantly?
Precisely. The reports today highlight that these AI systems are now testing software, generating complex documentation, and debugging. These were all previously billable human hours that are essentially evaporating.
If the volume of manual work drops because AI does it in seconds, the traditional revenue model for these IT giants is under severe threat. It's deflationary.
That is the bear case. But the real question is that actually happening on the ground right now? Or is this just a spooky story that hedge funds are telling themselves?
Because we have heard predictions about the death of coding for years now.
We have. And the Economic Times has a fantastic counterpoint piece today highlighting a report from KKR, the massive private equity firm. They are calling this moment an inflection point, not a death sentence.
What is their argument? Why are they bullish when all the FPIs are hitting the sell button?
Their core view is that the global demand for software and digital transformation is essentially infinite. If the cost of coding drops dramatically because of AI, companies won't just pocket the savings and stop building.
They will build more software.
Exactly. They will update their systems constantly. They will digitize old analog processes that were previously too expensive to modernize. The sheer volume of digital infrastructure will explode.
And someone still needs to manage all that chaos.
Right. You need systems integrators, you need firms to ensure the AI isn't hallucinating, that it's secure, that it integrates with 20-year-old banking software.
So the thesis shifts. Indian IT firms have to start being code factories and pivot to becoming AI managers.
That is the KKR thesis. And we are already seeing hard evidence of it in the corporate updates. Look at the data from Infosys highlighted in the reports.
What are they doing?
Their CEO mentioned they are currently working on over 4,600 distinct AI projects. And they've already generated 28 million lines of code using AI internally.
28 million lines. That is not a small pilot program.
No, it is industrial scale adoption. They have built over 500 internal AI agents. So Infosys isn't sitting around waiting to be disrupted. They're aggressively adopting these tools to become hyper-efficient.
The bullish argument then is that this transition actually makes them more profitable in the long run because their operational costs go down faster than their billing rates.
That's the hope. But clearly, looking at the market today, investors are not buying that pivot yet.
The market is in a strict show-me-the-money mode.
Exactly. Until these IT companies can prove in their quarterly earnings that AI is adding to their bottom line rather than cannibalizing their core revenue, investors are choosing to stay on the sidelines. The fear is that the transition period is going to be incredibly messy and painful for margins.
It is such a fascinating contrast. You have foreign investors fleeing tech stocks because they fear AI will destroy value. And simultaneously, on the exact same day, you have Mukesh Ambani betting $110 billion that AI is the greatest value creator in human history.
Let's pivot to that because this Reliance announcement is the headline that will likely outlive today's market crash in the history books.
I really want to talk about this. At the AI Impact Summit in New Delhi, Ambani didn't just throw out a massive number. He essentially announced a new national doctrine.
He did. The phrase he used was sovereign compute infrastructure. And we really need to unpack what that actually means because we usually hear the word sovereign in the context of borders or armies.
Right. What does sovereignty mean in the context of a data center?
It is a concept about digital independence. Right now, most of the high-level intelligence we interact with on a daily basis, whether that's ChatGPT, Gemini, Claude, runs on server farms physically located in the United States.
The brain is American.
Exactly. The foundational models are trained on American values, the physical hardware is subject to American energy grids, and the data resides under American legal jurisdiction.
So if things go south geopolitically or if regulations suddenly change in Washington, India is highly vulnerable.
We would essentially become a digital colony. We would be entirely dependent on renting intelligence from Western tech monopolies. Ambani's argument, and this is echoed by the Tata Group as well, is that for India to be a genuine superpower in the coming decades, the brain needs to physically reside in India.
We need to own the compute. We need to own the training data localized to our languages and context.
Yes, and look at the physical reality of what Reliance is building to achieve this. This isn't just software. They're constructing gigawatt-scale data center complexes in Jamnagar, Gujarat.
Jamnagar again. The traditional stronghold of their refining empire is becoming their data empire.
The reports state that 120 megawatts of that new capacity will come online by the second half of 2026 alone. That is incredibly fast for infrastructure of that complexity.
But here's the catch, and this is something I think retail investors often miss when they hear about AI, artificial intelligence. It's fundamentally an energy play. You cannot have intelligence without electricity.
Absolutely not. These advanced chips, like the NVIDIA H100s, they run incredibly hot. They require massive cooling systems. A single rack of these servers can consume as much power as an entire small neighborhood.
Which is why the second pillar of this Reliance bet is so crucial. They aren't just building the server farms. They are committing to building 100 gigawatts of renewable energy to power them.
100 gigawatts, that scale is hard to comprehend.
It's massive.
They are anchoring this compute vision with massive solar and wind projects in Kutch and Andhra Pradesh. This is classic Reliance vertical integration.
Right. They own the power generation, they own the fiber optic cables across the country via Geo, and now they will own the compute centers themselves.
It's a total stranglehold on the AI supply chain.
Yeah.
Unlike AI companies in the U.S. right now that are desperately lobbying utility companies for grid access, Reliance is just building its own grid.
And Reliance isn't the only conglomerate making a move. We saw N. Chandrasekaran of the Tata Group making major news today, too.
Tata has taken a slightly different, more partnership-heavy approach. They've announced a direct tie-up with OpenAI to build India's first large-scale AI-optimized data center.
So Reliance is sort of building the fortress from scratch domestically, and Tata is partnering with the global leader to equip theirs.
Roughly, yes. Tata is starting with an initial 100-megawatt capacity and plans to scale to a full gigawatt. But both conglomerates have clearly realized the same fundamental truth. Compute is the new oil. If you control the compute infrastructure, you control the economy of the 2030s.
It aligns so perfectly with what Prime Minister Modi was talking about at the summit. He unveiled this MANV vision.
Right, MANV. It translates to human in Hindi. It's a clever acronym, but the policy substance behind it is significant. Modi is trying to carve out a distinct third way for global AI development.
We have the American model, which is heavily corporate-led, closed-source, and profit-driven. Then we have the Chinese model, which is state-controlled and surveillance-driven. What is this Indian model?
The Indian model, according to the summit presentations, is designed to be democratic and human-centric. The core tenets are data sovereignty, meaning the data belongs to the citizen who generates it, not the corporation, and inclusivity. He focused heavily on building AI for the global south.
Which explains why French President Macron and Brazilian President Lula were given such prominent roles at the summit.
Exactly. It is a massive geopolitical signal. India is essentially saying to Brazil, to nations in Africa, to Southeast Asia, do not just buy American AI and become permanently dependent on them.
Partner with us.
Yes. Partner with India. We will build open, affordable systems that respect your national sovereignty and work in your local languages. It is a pitch to lead the non-Western tech bloc.
It is soft power projected through software infrastructure.
Absolutely.
But looking at the business standard lead story, there is a pretty major snag in this perfect picture of India as an AI superpower. While the big elephants like Reliance and Tata are making these huge sweeping moves, the actual startup ecosystem seems to be stumbling right now.
This is the reality check of the day. The report notes a complete pause in the reverse flipping trend.
Let's explain that term for a second. For the last couple of years, the big narrative was that top Indian startups that were domiciled overseas companies like Zepto, PhonePe, Razorpay were coming home.
Right, moving their headquarters back to India so they could eventually list on the Indian stock exchanges. It was seen as a huge vote of confidence in the domestic market.
And now, the trend has stopped.
It has hit a brick wall. And it is strictly about the math. It's about access to capital.
The valuation gap.
Exactly. If you are an ambitious AI founder right now, the investors in Silicon Valley are simply willing to pay a massive premium that Indian private equity and venture capital just cannot or will not match.
Give me the numbers from the report. I want to understand the scale of this gap we are talking about.
The disparity is shocking. In 2025, Indian AI companies raised a total of about $300 million.
Okay, 300 million.
U.S.-based AI companies raised $122.5 billion in the exact same period.
Oh, wow. 300 million versus 122 billion? That is not a gap. That is a completely different universe.
It is. So put yourself in the shoes of a founder. If you need to buy 10,000 NVIDIA GPUs just to train your base model, which costs hundreds of millions of dollars, you have to go where the deep pools of capital are.
And right now, the deep pockets willing to take those high-risk tech bets are still heavily concentrated in San Francisco, not Mumbai or Bangalore.
So the reverse flip is effectively on hold. Startups are delaying their return until Indian public and private markets can prove they have the appetite to fund high-burn AI models. The big conglomerates can self-fund their AI dreams off their own balance sheets, but the agile startups are stuck chasing American dollars.
So we have the physical infrastructure being built by the giants, but the capital markets are lagging behind for the innovators. That is a tension that is going to play out over the next few years. I want to pivot away from the tech sector for a minute and look at the broader economy. There were some really interesting nuggets buried in today's papers about the boring structural changes that actually have a massive impact on corporate balance sheets.
You're talking about the labor codes.
Yes, new labor codes. This has been a very slow-moving train in policy circles for years, but according to today's earnings data, it looks like it has finally arrived at the station.
And it is proving to be a very expensive arrival for India Inc.
Break down the headline rule change here, because it sounds obscure, but it hits everyone's paycheck.
The biggest change hitting the balance sheets right now is the mandate that an employee's basic pay must constitute at least 50% of their total cost to company, or CTC.
Explain why that ratio matters so much to an employer. Why do they care how the salary is divided up?
Traditionally, Indian companies would structure salaries with a very low basic pay component, and then they would stack up a myriad of allowances on top of it.
House rent allowance, travel allowance, internet, uniform allowance.
Exactly. And the reason they did this is because mandatory corporate contributions, like Provident Fund, or PF, and gratuity payouts, are legally calculated as a percentage of the basic pay, not the total salary.
Ah, so keep the basic pay artificially low, and the company's mandatory contribution to your retirement fund stays low. It saves the company significant cash flow.
Precisely. The government is now shutting down that loophole. By mandating that basic pay must be 50% of the CTC, the mandatory Social Security contributions from companies are going up significantly across the board. Plus, your gratuity payout when you leave the company will be calculated on a much higher base.
And we are already seeing this impact in the quarterly earnings reports.
We are. The Business Standard notes that for Nifty 100 firms, collective wage bills rose by roughly 17,600 crore rupees in Q3 alone. And a large portion of that was companies making financial provisions to comply with these new rules.
That is a direct structural hit to profit margins.
It is. Now, it's a fantastic development for the average employee. It means a stronger Social Security net and better forced retirement savings. But for investors holding stock in labor-intensive sectors, like security agencies, logistics, retail, or even traditional IT services, it is a permanent cost increase that isn't going away.
Right. Investors need to remodel their margin expectations for those sectors immediately.
Speaking of structural changes in the economy, we should look at the consumption data from Unilever today.
Yes, Unilever. They are the ultimate bellwether stock. If you want to know how the average Indian consumer is feeling, you don't look at tech stocks, you look at the company selling the soap.
And Unilever is making a huge statement of confidence. They are actively raising their stake in their Indian unit. Their stated goal is for India to contribute 20% of their total global sales in the near future.
It's currently at 12%, right? So 20% implies a massive expectation of growth.
It's a huge jump. It sends a strong signal that despite short-term inflation fears, despite the noise about rural distress we sometimes hear, global multinational corporations still view India as the only reliable, large-scale growth engine in the world right now.
But notice what specific products they are betting on to achieve that growth. This is the crucial detail.
Premiumization.
Exactly. They aren't betting their future on selling billions of more bars of cheap entry-level soap to the rural masses. They are betting heavily on selling premium body wash, expensive liquid detergents, and high-end skincare.
The consumer data firm Kantar, now called Numerator, predicts that overall FMCG volume growth, the actual number of physical items sold, will only be about 5% for
And
2026.
5% is pretty sluggish for an emerging market.
It is slow but steady. But the value growth, the actual revenue, will be much higher because a specific segment of people are aggressively upgrading their lifestyles.
It really paints a picture of a two-speed economy. The entry-level mass market is growing slowly, but the upper middle class is just premiumizing everything from their groceries to their cars.
That is the defining consumption story of India right now.
And speaking of groceries, before we get to the investor's cheat sheet, I have to ask you about the butter. This was honestly my favorite, weirdest headline of the day.
The Butter and Ghee Index update.
The government is fundamentally changing how they calculate the nation's GDP, and somehow butter is moving categories.
It sounds like a joke, but it actually has major macroeconomic implications. The National Statistical Office is updating the base year for economic data to 2022-23. As part of that, they are making the consumption tracking much more granular.
Right.
So they are moving butter and ghee out of the broad milk products category and placing them into a newly created oils and fats category. They're also moving ice cream out of dairy and into a sugar and desserts basket.
Why does this matter to anyone other than a government statistician?
Because it fundamentally changes how inflation weightings are calculated. Under the old system, if the baseline price of raw milk went up, it would mathematically drag the recorded price of butter up with it in the inflation index, even if actual butter prices hadn't moved much.
I see, so it was distorting the data.
Exactly. Now, butter will be tracked independently alongside cooking oils, which reflects how consumers actually substitute products. It makes the inflation data much more accurate to reality.
We are becoming a hyper-data-driven nation, down to tracking the last spoonful of ghee.
It might seem trivial, but remember, these exact inflation weightings determine the RBI's interest rate policy. If you measure inflation inaccurately, you set interest rates wrong, which impacts the whole economy. This granular update is actually a big deal for monetary policy going forward.
We have covered a truly massive amount of ground today, from the geopolitical risks in the Strait of Hormuz to gigawatt data centers in Jamnagar, all the way down to the price index of butter.
It has been a very wide canvas.
But we promise to distill all of this chaos into actionable intelligence. If you are an investor looking at a sea of red in your portfolio today, wondering if you should panic sell or buy the dip, what should you actually be focusing on?
Let's run through our investor's cheat sheet. 10 concrete takeaways from today's sources that matter for the long run.
Let's do it. Point number 1.
Sovereign compute is a capex supercycle. You have to ignore the daily stock price fluctuations. Reliance and Tata are preparing to pour billions of dollars into raw materials, cement, steel, industrial cabling, and massive cooling systems to build these data centers.
So don't just look at the tech firms.
Look at the physical infrastructure enablers. The companies that supply the builders are the hidden, immediate winners of this AI boom.
Point number 2.
AI is ultimately an energy play. You cannot decouple intelligence from electricity. Reliance's 100 gigawatt renewable target proves it.
Right.
If you are investing in power utilities, heavy electrical transformers, transmission line companies, or green energy equipment manufacturers, you are indirectly and perhaps more safely investing in the AI boom. The demand for industrial power is virtually guaranteed to skyrocket.
Point number 3, the IT sector transition.
The pivot is key here. Do not dump all your IT stocks indiscriminately just because of the AI scare narrative. You need to look for the managers.
The firm's actively adapting.
Yes. Firms like Infosys that are aggressively reporting high usage of AI agents internally are trying to ride the wave and become more efficient, rather than simply being crushed by it. It's a riskier play now, but as KKR notes, this valuation drop is a massive opportunity if you can pick the companies that will successfully pivot.
Point number 4 on the sheet.
The compliance cost squeeze is real. The new labor codes are hitting balance sheets right now. If you hold stocks in highly labor-intensive industries like staffing firms, large-scale security agencies, or traditional construction, expect their profit margins to be permanently squeezed by higher mandatory wage bills and Social Security provisions.
Point number 5.
Oil volatility is back on the table. The Strait of Hormuz geopolitical risk is not going away anytime soon. If crude oil stays elevated above $75 or $80 a barrel, sectors that rely on crude derivatives as raw materials like paints, aviation, and tires will see their margins erode quickly.
Be very careful with those downstream energy sectors right now. Point number 6.
Premiumization over volume. Follow the Unilever strategy. Don't look for consumer companies that are just chasing mass volume growth.
Because that growth is sluggish.
Exactly. Look for companies with strong brand pricing power that can convince the Indian consumer to upgrade to higher margin products. The real value growth is entirely in the premium segment today.
Point number 7.
The India Plus AI narrative. Goldman Sachs is officially calling this the top emerging market theme for the next 5 years. We are moving from the old China plus one manufacturing thesis to a new India plus AI services thesis.
This is the macro story that will keep foreign institutional money interested in Indian markets, despite the short-term volatility. Point number 8.
Startup IPO delays. With the reverse slipping trend on pause due to the massive valuation gap with the U.S., do not hold your breath for a flood of hot tech IPOs in Mumbai this year.
Right.
The supply of high-growth tech stocks on the domestic public market will remain scarce. This means public markets will remain dominated by legacy conglomerates and financial players for a while longer.
Point number 9.
Data-driven FMCG. With the new GDP base year and granular consumption tracking, the consumer goods companies that can best analyze these shifting patterns, who is substituting butter for oil, for instance, will win the market share war. Look for FMCG companies that are investing heavily in real-time data analytics.
And finally, point number 10.
Global South leadership. Track the companies that are actively exporting Indian tech infrastructure to emerging markets in Africa and Latin America. Modi's MANAV vision is opening diplomatic and trade doors in regions that American tech monopolies often ignore.
That is a massive, untapped export market for Indian software and digital public infrastructure.
Absolutely is.
That is a really powerful list. I think it clearly shows that while the ticker is bleeding red today, the underlying gears of the economy are shifting in massive, positive ways for the future.
Exactly. Extreme volatility is simply the price of entry right now. We have a legitimate war scare and a generational tech revolution happening in the exact same week. It's naturally going to be messy.
But as Mukesh Ambani and the Tata Group demonstrated today, the smart money, the really big, patient money, is looking way past next week's oil price fluctuations. They are already looking at 2031.
They are quietly building the physical foundation for the next decade. The real question for the listener is, are you reacting to the noise of today's crash? Or are you positioning your portfolio for the signal of this massive infrastructure boom?
A highly provocative thought to end on. Spend some time looking at those infrastructure enablers this weekend. That is your daily briefing here on The Deep Dive. We will be back tomorrow to see if the markets bounce back or if the bears are still firmly in charge.
Good night.
Good night.